Hello everyone, this is Dr. K. Jagannayaki, Professor in MBA Department, Institute of Aeronautical Engineering, Hyderabad. So today's topic is I want to discuss with you about the definitions and terminology used in the cost, production and other related cost concepts in business economics. So after going through this topic, the learner will be able to understand the meanings and definitions of various terms used in production. So let us start with production. What is production? The technical relationship which reveals the maximum amount of output capable of being produced by each and every set of inputs, that is known as production. So in general, the output production is derived with the help of an output is a combination of inputs N, L, K, T. So these four factors are known as productive resources, where N stands for natural resources, L stands for labor, and K denotes cost of capital, and T stands for technology. So using these four productive resources, the firms they use to produce output. So whatever relationship between the maximum amount of output capable of being produced by these set of inputs, that is known as production. Then what is isoquants? Iso means equal, quants means quantities. So in production analysis, we used to consider two types of production function. One is short term, another one is long term. In case of short term production function, we discussed already what is the law of returns to scale, which is also known as law of diminishing rate of return. Whereas in case of long run, all the production inputs they are variable, but in case of short run production function, except one variable, all other variables remains constant. So in case of isoquants, whatever may be the combination of the inputs, labor and cost of capital, it gives the same output. So if you take one labor, one cost of capital, then we use to produce 50. If you take two labor, two cost of capital, again you are going to produce the same amount. So as a result, if you are going to draw the production curve, we used to get the same irrespective of the combinations of input and output. So that is known as isoquants. Then what is isocast? The cost curve that represent the combination of inputs that will cost the producer the same amount of money. So whatever combination of inputs we are going to consider, the cost of the production, it remains the same. There is no change with the changes in terms of input variables. So that is known as isocast. Then what is cost? Cost is the expenditure incurred to produce a particular product or service. So here cost means we used to consider total cost. So total cost, it includes both the direct plus indirect cost. What do you mean by direct cost? Direct cost is nothing but the cost or the expenditure involved in the production process is known as direct cost. But whereas indirect cost means apart from the production cost, whatever expenditure incurred in a particular production process, that is known as indirect cost. So total together is known as cost. Then discuss about the marginal cost. So if you see in economics, marginal cost is the change in total production cost that comes from making or producing one additional unit. If you are going to produce one more additional unit, then what will be its cost per unit value? That is known as marginal cost. To calculate marginal cost, divide the change in production cost by the change in quantity. Then we'll get marginal cost. The purpose of analyzing marginal cost is to determine at what point an organization can achieve economies of scale to optimize production and overall operations. So, here, economies of scale means what kind of benefits of cost availed by the company. So, in general, the company may avail cost benefits in two ways. One is internal economies of scale, another one is external economies of scale. So, certain things they can able to analyze by taking the internal sources, whereas certain benefits they are going to avail from the external sources, such as like whatever subsidies provided by the government, and if you are going to include some other companies as well to support the R&D activities. So like that, we used to see that the cost of R&D will come down if you are collaboratively joining with another organization and you are working together. You can minimize that cost. So, if the marginal cost of producing one additional unit is lower than the per unit price, the producer has the potential to gain a profit, as the additional cost incurred for producing an additional unit. So, in general, the price is fixed like this: cost plus profit margin. So, what is the total cost of the product? Plus, for that, we used to keep some margin as profit. So, let us take every business person, they may include 5 to 10% margin on one unit of product. So, it depends on the negotiation and bargaining power of the buyer. Based on that, this profit margin may vary, but still they used to generate some kind of profits. That's how they used to decide the price of a commodity. Then elaborate the meaning of opportunity cost with suitable example. The opportunity cost is nothing but the time spent studying and that money to spend on something else. So it always tells us whatever time we have spent on a particular thing and how much amount you have spent on that. So that is known as opportunity cost. For example, if you take a farmer chooses to plant wheat, the opportunity cost is planting a different crop or an alternative use of the resources, land and farm equipment. So a commuter take the train to work instead of driving. So whatever opportunity we used to have, so grabbing that out of which we can minimize some cost, whatever you are planning to spend on. So that is known as opportunity cost. Then write about incremental cost. Incremental cost is the total cost incurred due to an additional unit of product being produced. So already the company they are producing 100 units per day, but if they are adding one more unit, that is 101 unit, then what happens? There is an increase in the expenditure just by adding one more additional unit to the existing production. So, incremental cost is calculated by analyzing the additional expenses involved in the production process, such as raw materials for an additional unit of production, the cost incurred to enhance volume or quality of production from one level to another level, even if you consider labor. So, at present, with 10 labor, you are making them to work on a particular task, but you have a target within one day you have to complete the task. then instead of 10 laborers, we need 20 laborers. So just by acquiring another 10 units of labor to the existing one, the cost will also increase by adding additional unit. So that is known as incremental cost. Then explain about sunk cost. A sunk cost refers to money that has already been spent and cannot be recovered. So already have spent money, but you know that it will not come, it will not be possible to recover that money whatever spent by you. So that type of cost is known as sunk cost. A manufacturing firm, for example, may have a number of sunk costs such as the cost of machinery, equipment, and the lease expense on the factory, and such costs that have already been incurred and cannot be recovered. So that is known as sunk cost. The next, describe the meaning of break-even analysis. So break-even analysis, it tells about the cost and what will be their possible impact on revenue and volume of the firm. So it is the case where there is no profit and no loss. It means that the total revenue is equal to total expenditure, and that point where the company neither generate profits nor losses. Hence, it is also known as cost volume analysis. So, even the concept of break even, it depends on the marginal cost. So, the marginal cost equation is C, which is known as contribution per unit, which is derived as follows. It is the difference between sales minus variable cost or fixed cost plus or minus profit and loss. So, by using this contribution margin ratio, one can analyze the sales at this break even point. Then, what do you know about the variable cost? Variable cost is that it varies with the level of output. Variable cost are any expenses that change based on how much a company produces and sells, such as labor, utility expenses, commissions, and raw materials, etc. So these costs may vary as you are going to make changes in the level of output. Based on that, we can also have changes in terms of variable cost. Then define fixed cost. So fixed cost, they are normally independent of company specific business activities. So whatever cost spent over on fixed assets like land, building, machinery, they remains constant throughout the level of production. So variable cost increase as production rises and decreases as production falls, but fixed cost remains the same whatever may be the level of production. Then elaborate the concept of out of pocket cost, which is also known as out of pocket expense or out of pocket cost. It is the direct payment of money that may or may not be later reimbursed from a third party source. For example, when operating a vehicle, gasoline, parking fees, and tolls are considered out of pocket expenses for a trip. Then define short run cost. Short run cost means it is the cost which has short term implications on the production process. It is the price of a product that has short term implications in the production process. It means that it is used across a limited number of end products, so which may not be applicable to all the products, only on a few specific products we can see that its implication. So these are the costs that are made only once and cannot be recovered, such as wages, raw material cost, electricity bills, and so on. The next, illustrate the term long run cost. So, generally, long run costs are accumulated when firms change production levels over time in response to expected economic profits or losses. So, in the long run, there are no fixed factors of production. So, when you are talking about the long run for the future, then all the factors become variable. There is no fixed factors of production. You take land, labor, capital, and entrepreneurship all vary to reach the long run cost of producing a good or service. The cost function represents the minimum cost of producing a quantity of some good. So, in the long run, all factors are variable and no factor remains constant. The next, what is profit? Profit means it is a financial benefit that is realized when the amount of revenue gained from a business activity exceeds the expenses, cost, and the taxes needed to sustain the activity. So, profit means whatever amount or revenue or income gained by the business entity after excluding all the expenses, total cost, and other taxes. So that benefit is known as profit. It is the money you have left after paying all business expenses. So there are three main types of profits: gross profit, operating profit, and net profit. Gross profit means it shows what money was left after paying for the goods and services sold. Then, operating profit means it shows what's left after also paying operating costs such as rent, electricity, phones, and in some cases, even staff also we used to consider. The net profit means it shows what you made after deducting all cost and tax. You get to hold on to net profit. So after all expenditures, all taxes, whatever amount left over with you, that is known as net profit. Then define total revenue. The word total revenue in economics, it indicates that the total receipts from sales of a given quantity of goods and services. It is also defined as the total income of a business and is calculated by multiplying the quantity of goods sold by the price of the goods. Thank you.
Like, share, and subscribe. Hit the bell icon for more updates.